Hi, you have seen many people are using jargons like time value of money, present value, future value, discount factor, opportunity cost. Actually, what are those meaning? Is it like that complex to understand? No, it's very simple. Everything goes to a one word called interest rate. Actually, what is interest rate? Interest rate is a return a equity investor or a lender or a saver expect for not spending the money and keeping it in a reserve account or for an investment purpose. So how these interest rates are decided? Interest rates consider few factors like real value, inflation and the other risk premium. So what is this real return? Real return is a return in an inflation free environment on a risk free asset, the return they expected by the investors. So for example, if you are investing in a treasury bills where you are assuming there is zero inflation, then that's a return you are expected by the investors. So the real return plus inflation, which is the nominal return, which is the risk-free investments including the inflation component. So the nominal returns are the returns that are expected by the US treasury bills, treasury bonds investor. Then in addition to that, we have to consider other premiums also. So what are those premiums? So the nominal return is including risk-free investments in government securities. So when you are investing in a private securities and when you are investing in a long-term period, the risk is increasing, the premium is increasing. So for example, liquidity premium, which expects when you are investing in a private securities where there is no liquidity market, the additional premium expected by the investor. Then the maturity risk premium, which is like when you are investing in a long-term 15-year corporate bonds versus 1 year business paper or a corporate bond, the return risk of 15-year corporate bond is high because there's high chances the business will file bankruptcy over a 15-year period, where for a 1 year period you have the visibility of the bankruptcy. Then when you are considering the time value of money, three concepts need to be considered. One is the money you are getting sooner is better. The larger money you are getting sooner is better. Then return from a risk-free investments versus risky investment. Risk-free investment is better and it will give higher present value. Thank you.